Most people don't realize this, but over 90% of investors fail to beat the market. That's right, despite all the news, tips, and advice, most investors end up losing in the long run. You might think that investing is about finding the next big thing or following the hottest trends, but that's exactly where most go wrong. What if I told you that your current approach to investing might be the reason you'll always struggle to build wealth? In this video, we're going to uncover the shocking truth about how certain habits are keeping you poor, and how to break them. We'll talk about why following the hype, relying on experts, and chasing quick profits can destroy your financial future. Instead, we'll dive into proven strategies used by the world's most successful investors. Stick around, and by the end, you'll understand why your current investing methods might be doomed to fail, and how value investing could change everything for you. Let's get started. Chapter 1. The Trap of Chasing Hot Stocks. Why you're gambling, not investing. We've all been there, seeing that hot stock trending online or hearing about it from a friend. Everyone's talking about it, and suddenly, it feels like you're missing out. But here's the harsh truth. That buzz around hot stocks is often just a trap. You're not investing, you're gambling. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Chasing trends often leads to paying inflated prices for stocks. And when the hype fades, the stock crashes. A study by Dalbar showed that the average investor earned just 2.6% annually over the past 30 years, far below the S&P 500's 10%. This is what happens when you buy into market euphoria without a solid strategy. Real value investing requires patience, not following every trend. A good value investor looks for companies with strong fundamentals, not just a good story. By sticking to this strategy, you're less likely to get caught up in the hype, and more likely to profit over time. Chapter 2. The Danger of Getting Rich Quick. Why slow and steady win. The allure of getting rich quickly is everywhere. There are countless YouTube videos promising fast fortunes and stories of people who seemingly hit it big. But the reality is, most of them are gambling with their money. If you want to win in the long run, it's all about the steady path. Take Buffett's advice again, our favorite holding period is forever. A study by Dr. Richard L. Peterson shows that 70% of individual investors try to time the market, but less than 10% of them succeed. The stock market rewards patience. Think about the legendary investors like Buffett, who have made their fortune by buying undervalued stocks and holding them for decades. Slow and steady investing, focused on a company's intrinsic value, leads to sustainable wealth. Don't rush to get rich, instead, think of investing as planting seeds for the future. Chapter 3. Ignoring the financials? You're building a house on sand. Let's talk about financial statements, the backbone of value investing. If you skip them, you're essentially buying a house without checking its foundation. That's a disaster waiting to happen. Peter Lynch, one of the most successful fund managers in history, once said, "Know what you own, and know why you own it." A stock might look good on the surface, but if its financials are weak, you're setting yourself up for failure. Analyzing a company's earnings, debt levels, and cash flow is crucial. According to a 2019 study by the CFA Institute, 80% of companies that failed in the market had high debt-to-equity ratios. Don't let yourself get fooled by superficial metrics. Understand the company's true value by digging deep into its financials. The more you know about a company's health, the less likely you'll fall for surface-level excitement. If you're finding this video helpful so far, don't forget to hit that subscribe button. It's the best way to stay updated with valuable investing tips that can make a real difference in your financial future. Chapter 4. The Perils of Emotional Investing. Why your feelings are costing you. Investing with emotions is like trying to drive with your eyes closed. You're bound to crash. Emotional decisions can wreck your portfolio faster than anything else. Fear, greed, and overconfidence led investors to buy when they should sell and sell when they should buy. Take the 2008 financial crisis, for example. Many investors sold out of fear and missed the recovery. A study by Morningstar found that investors who make emotional decisions tend to earn significantly lower returns than those who stick to a disciplined strategy. Emotional investing is why the average investor earns so much less than the market's long-term returns. Avoid reacting to daily market swings. Stick to your value investing strategy, where you focus on intrinsic value, not short-term noise. Chapter 5. Stop chasing dividends. Are you trading stability for illusion? Chasing high dividend stocks can be tempting. Who wouldn't want a steady stream of passive income? But here's the catch. High dividends can often be a red flag. They might signal that a company isn't reinvesting in growth or has an unsustainable payout ratio. As Buffett put it, you want to own a business, not a stock. Many investors fall into the trap of focusing on dividends without realizing that growth is just as important. Take GE for example, which once paid huge dividends but was forced to cut them during tough times. Instead of chasing dividends, focus on finding undervalued companies with solid growth potential. A company that reinvests in its business today will likely offer more value in the long run than a company just focused on short-term payouts. Chapter 6. The hidden dangers of following expert advice. Why you're better off doing the research yourself. We all love expert opinions. But relying too much on so-called financial gurus can be a huge mistake. Just look at the experts who told everyone to invest in tech stocks before the dot-com bubble burst. In reality, expert predictions are often wrong. As author Michael Lewis puts it in The Big Short, the most difficult thing in investing is the ability to ignore the crowd. If you follow the crowd, you're simply playing a game of catch-up. Do your own research. Look at the numbers. Read the financial statements. In fact, a study from the Journal of Finance found that investors who rely on independent research outperform those who follow popular financial media. Don't let expert opinions cloud your judgment. Build your strategy based on facts, not hype. When you rely on your own research, you take control of your financial future and avoid the costly mistakes made by following the crowd. And before we wrap up, don't forget to subscribe. If you're serious about changing your investing game and learning strategies that actually work, hitting that button is the best way to stay ahead.